Hello, everybody, and welcome to this week's MarketMaker.io Bitcoin market update. And today we're going to be talking about none other than Bitcoin as always. So right now, Bitcoin is up on the day since yesterday, sitting at around $39,000 in anticipation of the New York Stock Exchange opening in about an hour. So we bounced off that low we made yesterday at around $37,500. And remember, this was a pretty key technical level that those hoping for the bullish scenario would have liked to have seen a bounce from. So far, that's quite good because it's allowing us to maintain on the higher time frame view a series of higher highs that we've been discussing. So that nice bullish market structure from a technical standpoint has not been broken as of yet. And on a shorter term time frame, this series of lower lows that we had been making on the hourly chart since mid-April has been broken as of now. What we'd want to see in the bullish scenario is, of course, for Bitcoin to come up a bit higher, perhaps up to $42,000, come back and retest this level to confirm that breakout on the shorter term time frame. But what it's going to really come down to, of course, all eyes are on the FOMC meeting later today at around 6 p.m. British time. That's why we can really expect for this trading session for today for stocks when the New York Stock Exchange opens to be quite volatile. Basically, in favor of the bullish scenario, what we do have right now, thankfully, is quite a severe tightening schedule being baked into the price, being priced in by markets already. So markets are already anticipating 50 basis points of hikes at this meeting. And then they're anticipating 75 basis points hikes for the mid-June meeting. This means it's going to be quite difficult for the Fed to come out and scare the markets further in our view. This increases the risk here of some type of buy the news event, at least for the short term. We are oversold in traditional markets. On the stock market, we are quite oversold from the technical standpoint. And so at some point we were anticipating a relief rally, even if we were to continue the overall macro bear market across the board in markets that we've seen really since November when the Fed first started tightening. Obviously, in the bearish scenario, if Jerome Powell, if the announcement accompanying the 50 basis points of hikes were to be even more hawkish than what we've heard previously, then of course markets would sell further. The Nasdaq already making a lower low on the key time frames, which would be worrying because obviously Bitcoin and the Nasdaq, as we've discussed previously, are quite tightly correlated at the moment. And so that would open up the possibility for this bullish structure on the higher time frame to be broken if we were to come down and make a lower low. We could anticipate some severe downside. But I also want to reiterate this point that we spoke on last week. Last week, we actually focused on this idea of Bitcoin outperforming the NASDAQ, of Bitcoin handling this sell-off in the wider traditional market sphere better than stocks since November, really, as is illustrated by this chart where we have the Bitcoin versus NASDAQ ratio. And you can see here that like the Bitcoin chart, it's also been making higher highs as we discussed last week. I want to point out in the news a comment from one hedge fund manager named Paul Tudor Jones here. I'm showing this tweet from Will Clemente where he describes the comments that he made on television, saying clearly, you don't want to be long stocks or bonds right now given the macro environment, but it's hard not to want to be long crypto because of the pure amount of intellectual capital coming into the space. So he also did mention the fact that, especially when we talk about crypto, I mean Bitcoin in this sense, that the lack of counterparty risk makes Bitcoin, or can be viewed by investors as something that's unique from stocks, which of course are more so at the whim right now of the bond market. The bond market is more so at the whim of third parties like monetary policy makers, for example. That sort of encapsulates the issue right now in traditional finance. And what this chart is saying is that the marginal market participant could be agreeing with Paul Tudor Jones, right? So since the November sell-off across all markets, we've seen a stronger bounce for Bitcoin. Bitcoin's holding up while the NASDAQ is actually making lower lows already. So, I'd have to agree with Paul Tudor Jones, and as of right now, the data is in support of the way he is viewing the trade-off between stocks and crypto. It doesn't mean that crypto would not sell off if the Nasdaq and stocks overall were to fall further. Of course, that's not what this chart is saying at all, and I'm not trying to imply that at all. It's just that it flies in the face of this idea that Bitcoin and crypto will necessarily go down even harder than stocks in the case of a traditional market meltdown. Right? This is what many pundits say. It's sort of what many people assume off the top of their head, but the data isn't supporting that. So moving on. In the bearish scenario, right? So if the Fed were to come out today and we were not to get this buy the news event that we are personally anticipating today, what if Jerome Powell comes out and actually hikes by 100 basis points and says that they're going to take $200 billion a month rather than just $100 billion a month out of the system in the coming months? Well, in that scenario, it would not be a surprise for Bitcoin to sell off further, of course. So we've talked in previous weeks about one potential bottom in sort of the worst case scenario being $24,000. Now, the reason I said $24,000 was because this is the level at aggregate where the market on average acquired their Bitcoin. And in past capitulation events, say in 2018 and 2020, the market did get to around these levels. So that's one nice way of thinking, having a ballpark picture of how bad things can get. Another way to look at it, though, might be the amount of entities in profit. And I'm showing here this data presented from Glassnode. And what it's saying is that right now we're sitting at a profitability at around 70%. And in the two past capitulation events in 2018 and in March 2020, we got to levels of profitability around 50%, and in March 2020 actually 57%. So that's about a 10% fall further, and this would imply, if we were to see that kind of capitulation, levels at around 32,000, 33,000-ish, which is slightly more favorable. Still would be dramatic, still would scare a lot of people, but it wouldn't necessarily put as much of a dent in this chart on the higher time frame as if we were to go down to 24,000. So something to bear in mind. I also want to make the bigger point here, and that's that, and this is something that I've reiterated in past weeks here, which is that the Fed tightening or the Fed hiking rates historically has not necessitated some type of collapse in asset prices. It does not mean necessarily that assets cannot have relief rallies or even have bullish continuation. We've seen across many economies throughout history when monetary policy at least begins to tighten, that markets do panic, that financial conditions do tighten, which they have, and markets do tend to have a hard time digesting that information. But what really matters for stocks is not necessarily the fact that tightening has initiated, but really it's about the degree to which they tighten, the pace at which they tighten, and the degree to which that tightening overshoots expectations, right? So if tightening were to exceed expectations, if inflation were to surprise to the upside, yes, that could definitely kick us into territory where we see sustained weakness. But as of right now, remember, no money has actually been taken out of the economy yet. The money supply on according to the data that I've seen, even as early as late as last month, I've seen some measures of the money supply continue to increase. So here we see that the last time the Fed started a round of tightening, which was at the end of 2015, Bitcoin did go on to have a parabolic bull run. Markets did quite well as well. And so it's not to say that this time will be the same. It never is, but it's just something to consider that in fact, across many economies, what we've seen after the initiation of a tightening cycle is a melt up before perhaps a final capitulation later, when the monetary tightening actually comes to fruition and when the actual money from the economy is being removed significantly enough to cause damage. What we're seeing here right now is a pretty interesting situation where the tightening that we've seen in the market from yields rising, regardless of, as we said, quantitative tightening has not really started. Rates have barely started to come up. What we're seeing is that tightening that the market's already doing itself is causing things to break, right? So your ARK Invest stocks, your high growth tech stocks have had a pretty severe bear market, and they're actually trading right now at levels where they did in March 2020. So on many metrics, we already have seen a lot breaking. And it's the point here that I'm trying to make is just to make sure to keep an open mind, keep your time frames in mind. We can have a relief rally, we can have months or even a year of bullishness despite the ongoing tightening before we were to see the full ramifications of that tightening. So as an analyst, I'm trying to do my best to keep my feet on the ground, keep my expectations in check, and keep an open mind. All right, that's it for this week, everyone, and thanks for tuning in. Speak to you next time.